priced if we're moving on this transition. And like virtually everything else with respect to climate change, the process of building this sustainable financial system is not moving fast enough. And so, and some of this is highlighted in the publications here. The fund can play an essential role. So I'm going to talk about three things. Take a page out of Christine's book. They all begin with R: reporting, risk management, and returns. Start on reporting. This is climate disclosure. The TCFD was catalyzed by the G20 process, overseen by the FSB, but delivered by the private sector. And so this is a comprehensive approach to climate disclosure across our countries. There is now $120 trillion of assets behind these disclosures. In other words, asking for these disclosures. That's the major systemic banks, largest pension funds, top asset managers, et cetera, all the rating agencies, all the accounting firms, et cetera. So the question is the response of the users of capital in starting to disclose against this. Top 1,000 companies worldwide, you see more than half of the disclosure requirements with the TCFD are now starting to come. The point, and it's hinted at it in the GSFR, hinted at appropriate, but I'm going to be explicit, is to make it mandatory. Make it mandatory, but not today. Make it mandatory sort of a few years out. And this is something that the EU has signaled as possibility. The UK government has as well, and I think it's a good, fair likelihood. And so companies should be reporting and refining and getting this right before it happens. Secondly, on risk management, in the private sector and for the supervisors, and we include ourselves in this, we all need to improve our understanding of how to manage climate-related risks. And to be clear, climate-related risks are not just the physical risk, but the transition of the economy to net zero. And the biggest question is the strategic resilience of borrowers, companies, to that transition. The Bank of England has just set out its supervisory expectations for all the banks and insurers in London. That's $11 trillion of assets, and we are going to stress test the banks. We are currently stress testing the insurers, but we're going to stress test the banks at the heart of the global financial system over the next 18 months around these issues. So how well they are prepared for the transition to net zero. And I think what we're going to find is that the banks, their exposures, their lending to companies will go in three buckets. Some companies who do have strategies for the transition, some who are gambling on either new technology or government inaction. Maybe I shouldn't say gambling, but expecting government inaction. And the third would be those who haven't really thought it through. But as a part of this process, they will have to think it through because capital will have to be allocated against those risks. Now, I want to compliment the Banque de France, the PBOC, and the Netherlands Bank, who've helped found with us the Network for Greening the Financial System, which is a group of 47 central banks, regulators, and now the IMF has just joined as observer status. And this is how this perspective on risk management cascades and develops through the system. It's well over 55% of global emissions covered by this group, and it'd be important to work through it. And I would suggest that as the fund, as this moves forward, incorporating climate risk management as part of Article 4's FSAP's technical assistance, gradually building up those capabilities is important. Finally, on returns, virtually every financial asset is ultimately going to be repriced around these assets. Some of them are going to go up quite substantially, some will go in the other direction. But this is everything, so it's not in a niche. And when we think about taxonomies that are developed, there is a place for green taxonomies that are absolutely clear about what is green. But for the system as a whole, we don't just want to put things into a purely deep green bucket, and everything else is encouragably brown. I think of it as 50 shades of green. The managing director is much more diplomatic. I think you think of it as olive or shades of olive, which is probably a better way to put it. But the question is, how do we report in a consistent way? These are asset owners. Transition indices is one, but the leading pension funds and insurers are beginning to report the degree warming potential of the asset sides of their balance sheet. I'll take the page out of the GPIF, the Japan Pension Fund, 1.6 trillion of assets, 3.5 degrees, consistent with global warming, 3.5 degrees for those assets, which is good for the capital markets, which tells us the scale of the challenge. But the question is whether that would be spread more broadly. So I'll just finish on this. So there's an agenda there. The fund can play an absolutely central role. And for ministers around the table, that as this system, as it moves more mainstream, the financial system will do what it does best, which is pull forward adjustment if you have credibility around your climate policy. So think again, I'll just reference the fiscal monitor in the chapter on carbon pricing. It will pull forward the adjustment, it will amplify the effect, and it will make your job easier if we put these in place. My last word again from the Chancellor, the UK is co-chairing COP26 with Italy. It's a big responsibility, but you can expect that these types of issues will be front and center. Thanks.
Thank you.
At the same time, downside risks to the global economy seem to be high. There are a wide range of risk factors, including trade tensions, the development of Brexit negotiations, and geopolitical uncertainties. Under these circumstances, business confidence in Japan has been weakened further. According to the latest Tankan business survey, the closely watched indicator of large manufacturers' confidence declined markedly in the third consecutive quarter. At the same time, however, adverse impact on domestic demand seemed to be limited. Despite the weakening of business confidence, business investment remains resilient, supported by long-term strategic investments such as labor-saving technologies, R&D, and urban developments. Those types of investments tend to be less susceptible to global business cycle. With regard to the housing sector, private consumption keeps increasing at a moderate pace against the backdrop of the continued improvement in the employment and income situation. The economy is growing around 1%, but consumer price inflation has been at around 0.5% and relatively weak compared to the economic expansion and tight labor market conditions. Looking ahead, we broadly share the view of the World Economic Outlook that the global growth is to pick up toward next year as supported by accommodative financial conditions. One silver lining is that IT cycle seems to be bottoming out. That said, however, no clear sign of a pickup of the global growth has been observed. Given the variety of downside risks that I have mentioned, we should be mindful that the pickup might lag behind by longer than expected. As for monetary policy, with growing risks and uncertainties of the global economy, the Bank of Japan assesses whether the momentum toward achieving the 2% price stability target will be maintained. If the bank sees a greater possibility that the momentum will be lost, we will not hesitate to take additional easing measures as appropriate. Let me stop here.
Thank you very much.
IMF established a capability development center, and by which we can help train people, officials from low-income country for a lot of classes, including managing debt and for the debt sustainability. We will continue this effort, and in the balanced growth of global, especially help the poor country, we think that the overall consideration on the debt sustainability is very important. On the climate change agenda and green finance, we will do our best, working together with colleagues around the table, have the sustainable financing, growth financing program forward in the recent future. Thank you.
Economy is strong with solid growth, low unemployment, solid job creation, wages moving up, high confidence, and those sorts of things. If you look in the manufacturing sector, you see a different picture. You see weak manufacturing, low investment, and low exports. So looking forward, overall, we see a continued moderate growth around 2% driven by the household sector, and inflation moving back up to 2%. But of course, there are significant risks to the downside for that outlook. Notably, global growth has weakened over the last year and a half, and trade policy uncertainty is weighing on business sentiment, and inflation is running persistently below our 2% target. I'll say just a word or two about the problem of persistently low inflation. In principle, having inflation a couple of tenths below 2% is not a serious concern. The concern really is more we see around the world the strong disinflationary pressures, and we don't see ourselves as exempt from those. So we also see that when inflation expectations slip downward, it's hard to get off that road, and we want to avoid doing that. So we're strongly committed to our 2% inflation. It's actually a key subject of our ongoing review of our monetary policy strategy tools and communications. So on monetary policy, we've been calling out these downsides, and we've shifted our view of appropriate policy over the course of the year from one of raising rates to being patient and now having cut 50 basis points. And we're going to continue to use our tools to sustain this very long expansion. Our view has been that the situation calls for a relatively modest adjustment of policy, not the kind of aggressive rate cuts that would be needed in the event of a sharp downturn. We, of course, have no way of knowing that with any certainty, and we will continue to do what we feel is appropriate to support growth. Monetary policy tools are powerful, and we'll use them as we have for the past decade, but there is clearly a need for more pro-growth fiscal policy, regulatory policy. We applaud the potential reductions in uncertainty that we've been seeing just in recent weeks around Brexit and around U.S.-China trade relations. So with that, I'll mention just there seems to be a great deal of interest based on the last couple of days in what's going on in U.S. money markets. I'll quickly mention that. Since 2017, we've been gradually shrinking our balance sheet so that it's no larger than it needs to be. We surveyed all of our banks and asked them what's their lowest comfortable level of reserves. We added all that up, we put a buffer on top of it, and we felt that our level of reserves was somewhat above that level. Turned out in September that was not the case. We discovered that actually reserves were at that point of scarcity, and it may well be that we have plenty of liquidity, but that it's actually less liquid, less fluid, less flexible than we had thought. So that's something we're going to be thinking about. We reacted quickly with open market operations and now have announced a more permanent solution of asset purchases. Two key points. One is that we will use our tools to keep our target range, our rate in its target range, and with that accomplished, there are no macroeconomic implications of these changes whatsoever. I'd also note that we're buying treasury bills, short-term securities, and quantitative easing, we think, works through buying long-term securities and depressing term premiums and lowering longer rates and supporting economic activity through that channel. These asset purchases should, in principle, have no effect at all on the stance of policy, so we're being very clear that they're not quantitative easing. You may have heard us say that a few times. I will just close with echoing some of the earlier comments on international collaboration. I just want to say that the Fed is strongly committed to this institution and this meeting, and also to the many other international forums in which we participate. We'll participate and collaborate respectfully and vigorously, and you can be sure of that. Thank you.
Thanks, Jay. Governor Egan.
All of us. And since you thanked Christine for collaboration that has led to the fund being more relevant on the sustainable development goals, certainly more relevant on climate, more relevant on inequalities, I want to give you my word that we will continue exactly in that spirit. So in 5 years, I can earn the same from the UN that Christine earned today. Thank you, Secretary General.
Testing times. Many people are losing faith in the process of globalization that is leaving them behind, and in institutions and leaders who are meant to deliver. The number of riots that are taking place today in the world is, I believe, something that I don't recall in any other period of my public life. And global growth forecasts continue to drop, tensions around global trade and technology continue to rise, and as I said at the United Nations General Assembly, I fear the possibility of a great fracture with the two largest economies splitting the globe into two, each with its own dominant currency, trade and financial rules, its own internet and artificial intelligence capacities, and its own zero-sum geopolitical and military strategies. It is not too late to avoid this. We must do everything possible to maintain a universal system, a universal economy with universal respect for international law, and a multipolar world, but with strong multilateral institutions, such as the World Bank, the IMF, the WTO, not to mention the UN itself. And we have an important instrument to help navigate in this turbulent world, the 2030 Agenda for Sustainable Development, our shared blueprint for a fair globalization. Yet, we are far from where we need to be in reducing inequality, in addressing the climate crisis, in tackling global hunger, in achieving gender equality, and in expanding opportunity for young people. We must step up our efforts now to achieve the 2030 Agenda and the Paris Agreement on climate change. Other important partners are joining in support. Last month, 130 major banks, representing 1/3 of the industry, launched the principles of responsible banking to advance sustainability in their products and services towards achieving the Sustainable Development Goals. It was a remarkable event in the General Assembly of the United Nations. And just this week, along with 30 CEOs of some of the largest financial firms, representing $16 trillion in assets, I launched the Global Investors for Sustainable Development Alliance to help unlock long-term investment. Many are deeply committed to innovative forms of finance, including green, sustainable development, and social impact bonds. But we must do far more, and fiscal policy and financing will be pivotal. Allow me to highlight 3 action areas. First, making tax systems smarter, greener, and more aligned behind the sustainable development and climate action agendas. This includes eliminating wasteful fossil fuel subsidies and putting an appropriate price on carbon. Let's not forget that fossil fuel subsidies are funded by taxpayers, and taxpayers do not want their hard-earned money used to boost hurricanes, spread drought, and melt glaciers. I understand that in some developing countries, some of these subsidies address problems of poor areas of the population. But if that is the case, it's better to subsidize people than to subsidize fossil fuels. And there are many proofs that that can work. And it's time to shift taxes from income, including payroll, to carbon. This would create a win-win solution, and I think it would be fully backed by the middle class around the world. Countries must intensify their efforts to mobilize domestic resources, including through tax reform and other good governance measures, but at the same time, the international community must take much more effective steps to fight illicit flows of capital, money laundering, and tax evasion, which continue to drain vital resources from the developing world, namely from the countries that are serious in addressing their own handicaps and in developing their own reforms. Second, we must align the international financial system behind the Sustainable Development Goals. And that means incentivizing sustainable long-term public and private financing. It also means revisiting financial regulations that may inadvertently encourage short-termism in financial markets. Third, it is time to break the cycle of excessive debt build-up followed by painful debt crises. That requires taking a systemic approach that commits creditors and debtors to lend and borrow responsibly. And we must keep a focus on countries particularly vulnerable to the impacts of the climate crisis, namely small island development states, even when they are middle-income countries. I fully support proposals to convert debt to investment in resilience, such as through the Debt and for Climate Adaptation Swap Initiative, and I believe we should move these from an idea to a reality. Excellencies, together let us raise ambition for development finance, climate finance, and finance that is inclusive and enables markets to grow, businesses to thrive, and people to live in dignity. Thank you.
Whatever it takes. There was one more sentence that came after whatever it takes, and it was, and believe me, it will be enough. And I am so proud that you made the world believe you, and it was and is enough. So, Christine, you are inheriting that trust in Europe that Mario built for Europe, for Eurozone, for Europe, but also for the world, a stable currency to rely on. And for Mark, you have taken on a very big transformational task in central banking, and it is to protect the world's financial system from shocks that are likely to come with climate change. And for this, we are grateful, but even thank you very much, both. Mario, Mark.
Mario and Mark, it's your opportunity to speak unscripted.
Thank you for your words that are almost embarrassing in their praise. Let me say that first of all, I should be thankful for being here, because not many of you know that the ECB here is a guest, is an observer. So, Christine, you pass from being an MD to being an observer. And that's thanks to a decision that was taken by the IMFC in 1998. I actually participated in the session to 27 IMFC meetings. And I should say that I should just remember the 6 great presidents of the IMFC. The first was Gordon Brown. The second one was Tommaso Padoa-Schioppa. Then we had Youssef Boutros Ghali. Then we had, then we had Tarman. Then we had Augustine. And then we had Lesesha. So thank you to all of you. During these meetings, of course, I had the plenty of opportunities to understand and appreciate the complexity and the success with which the IMFC is performing its task. Its guidance for the IMF, its support, it's, as Christine said, it shields the IMF, but all over, it's one of the pillars of multilateral cooperation. In this sense, at this present time, this forum is an especially precious thing that we want to preserve. Thank you.
I'm really enjoying this. I first attended, I'm glad you didn't go through my attendance record, but I first attended in 2003, the IMFC, and some of you were there. Or remember those days, but it involved sitting around a table in a slightly dimly lit room, trying to figure out what Alan Greenspan meant, and then Gordon Brown table dropping the communique language, and him furiously trying to get it through while we negotiated it. It was, now, look at the difference. Look at the difference. It's an open setting. It's the world. It's not focused on the hegemon. It's the world. It's a free exchange of views. It is and it's down to your leadership, Christine, this transformation, and the leadership of the chairs of the IMFCs that have brought it to this position. And it is exceptionally valuable global public good. So full credit to you and to everyone around it. I will say that whether it was in financial reform or the issues that we had either in Canada or the UK, that when you come to these meetings, you draw on the strength of the people here, the institutions, your insights, and your examples. And for that reason, we have the fund. We have exceptionally capable leadership and Kristalina to take the fund forward. But we have, as important, if not more important, we have the process that's been developed. That means we get the best out of each other. And so I will sleep absolutely soundly, knowing the world is in these good hands. Thank you very much.